Welcome back to the CFO's office. In our last session, we did the dirty work. We walked through the garden of your portfolio and pulled out the weeds. We learned how to execute a stop loss, how to admit failure, and how to close down non-performing divisions. It was painful, but it was necessary. Now the air in the room is different. The mood is lighter. Because today, we are looking at the flowers. We are looking at the investments that went right. You bought a stock at $10. It went to $20, then $50, maybe even $100. The numbers on your screen are green and beautiful. But now you face a new problem. A happy problem, but a dangerous one nonetheless. The question haunts every successful investor. When do I sell? If you sell now, you lock in the profit. You feel smart. But what if the stock goes to $200? You will feel regret. You will feel like you got off the train too early. If you don't sell, you might make a fortune. But what if the stock crashes back down to $10? You will feel like a fool. You will realize that your wealth was just a hallucination. Greed is a much harder emotion to manage than fear. Fear makes you want to run away. Greed makes you want to stay at the party too long. Today, we are going to establish the criteria for profit-taking. We will answer the eternal question of the CFO. Do we pay out dividends, or do we reinvest for growth?
First, we must understand a fundamental truth of accounting. Unrealized gains are not profit.
Until you click the sell button, that money is not yours. It belongs to the market. The market has just lent it to you for a while. At any moment, the market can ask for it back.
So, how does the CFO decide when to make that money real? We use 3 specific frameworks.
Framework number 1, the free ride rule, or the house money rule.
This is the best strategy for psychological peace.
Let's say you invested $10,000 in a risky tech stock. It doubles to $20,000.
The free ride rule says, sell $10,000 worth of stock.
You have now recovered your initial principal. You have zero risk on the table. The remaining $10,000 is house money. If that stock goes to the moon, you participate. You are happy. If that stock goes to zero, you don't care. You lost nothing. This strategy eliminates the emotional burden of the trade. It allows you to hold the remaining shares with diamond hands because you have nothing to lose.
Framework number 2, the valuation ceiling. The CFO does not look at the price chart.
The CFO looks at the value. If you own a grocery store chain that usually trades at 15 times its earnings, and suddenly, because of a hype bubble, it is trading at 50 times its earnings, you must sell. Why? Because the price has disconnected from reality.
When the market offers you a ridiculous price for your asset, you should be a polite merchant and accept the offer. Don't be greedy.
Don't think. It can go higher. When the valuation becomes absurd, you are no longer investing. You are playing the greater fool theory. You are hoping to sell to someone dumber than you. That is a dangerous game.
The CFO takes the profit and exits the building. Framework number 3, the goal achievement. What is the money for?
Remember our session on freedom for? If you invested money to buy a house in 5 years, and the market gives you enough money to buy that house in 2 years, sell. Take the money. Buy the house. Fulfill the mission.
Do not gamble with the money you need for a specific goal just to get a little bit more. When the target is hit, the mission is over. Bring the soldiers home.
Now, let's discuss the second part of today's topic.
Dividends versus reinvestment. You have taken profit, you have cash in your hand. Or maybe your stocks paid you a quarterly dividend. What do you do with this cash? Do you transfer it to your checking account and buy a nice dinner, dividend? Or do you buy more shares, reinvestment? This depends entirely on the life cycle stage of you.
Inc. Stage 1. The growth phase. If you are under 50, or if you have not reached your financial freedom number, your policy should be 100% reinvestment. You are a farmer in the spring. You do not eat the seeds. You plant them. Every dollar of profit, every dividend check, must be plowed back into the soil. You are feeding the compound interest machine. Taking dividends out at this stage is like eating your own children. It destroys your future potential. Stage 2. The harvest phase. If you have reached your financial goals, or if you are retired, your policy changes. Now you switch to dividends. You are a farmer in the autumn. It is time to eat. You stop reinvesting. You use the cash flow to pay for your life, your travel, and your medical bills. You move from wealth creation to wealth enjoyment. The mistake many people make is mixing these stages. Young people take profits to buy luxury cars, eating the seeds. Old people reinvest everything and live poorly, dying with millions in the bank, never harvesting. The CFO must be clear about the stage of the company. Are we building the factory? Or are we running the factory?
Let's summarize the CFO's profit-taking policy. Don't let greed blind you.
Unrealized profit is a phantom. Use the free ride rule. Take your principal off the table when you win big. Respect valuation. If the price is crazy high, sell to the crazy buyers. Know your stage. Reinvest in the spring. Harvest in the autumn. Implementing these rules requires discipline. It is hard to sell when everyone is celebrating. It is hard to leave the party when the music is still playing.
But remember, the only people who get hurt on a roller coaster are the ones who don't get off. So you have followed the rules. You bought low. 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 Low.
You sold high. You took profits. You have a pile of realized gains in your account. You feel rich. You feel victorious. But wait, there is a knock on the door. It is not the market. It is not your broker. It is the government. Whenever you make a profit, you have a silent partner who demands his share. And his share is larger than you think. If you do not plan for this, your victory can turn into a nightmare. In the next episode, we are going to open the tax code. We are going to discuss complete guide to taxes, capital gains and dividends. We will learn the difference between short-term and long-term taxes and how the smart CFO legally minimizes the bill. Profit is not what you make. Profit is what you keep. I'll see you in the next video.